Today, many of us are obsessed with money. Investing in Bitcoin, buying this or that stock on the stock exchange, getting rich through a rapid market fluctuation. Many of us love talking about these kinds of things in conversations with friends and at gatherings. We eagerly await the day we'll strike it rich, you see. But the world was very different in the past. People could live for years without seeing money or doing business with money. Interest rates, which are considered perfectly normal today, were unthinkable. There were no public or limited liability companies. The stock market didn't exist. Making money from money was unthinkable. So what happened to change our world so much? Talk about the history of finance. How did public companies, stock exchanges, and bonds originate? We will take a look at this issue. If your mind is ready for paper, pen, and complex calculations, let's begin. Sir, when talking about the history of finance, we actually need to focus primarily on capital. Ultimately, the entire financial system is driven by a hunger for capital. Let's say I have a significant amount of money and I want to invest it somehow. But I don't have a profession, and there's no more profitable investment plan in mind yet. On the other hand, you have a new investment plan but no capital. At this point, the smartest thing we could do is for me to lend you my money to invest. Of course, I'm not lending it to you out of charity. Ultimately, the time until you repay the loan is a risk for me. I could have spent that money on other things and made significant profits. Also, the risk of not getting my money back after waiting that long is another concern. So to reassure me, you set an interest rate. You say that when I repay the loan, I'll add a certain amount to it. In this way, I both profit from the interest and significantly reduce the risk. This form of capital production is truly clever. Therefore, we've encountered similar relationships since the earliest written accounting records. For example, those who watched our video on the history of money will remember. We talked about a Sumerian merchant named Cushim who borrowed barley. When Cushim repaid his debt, he had to pay around 30% interest. This usury had severe consequences for borrowers at the time. As we explained in that video, blindness actually originated from this system. However, people couldn't give it up. As a result, lending became profitable and those who wanted to do business easily found capital. Therefore, people continued to borrow with interest, even if it meant becoming slaves. Ultimately, new investments were needed for new ventures. Speaking of investments, let's get back to our topic. The first objections to interest also emerged in the ancient world. For example, Aristotle says that money is sterile. According to him, tokos, that is, money begets money, is against nature. Aristotle considered subsistence, or economy, which is the basis of the word economy, quite natural. Furthermore, it was a perfectly natural method of making money in trade if there was a risk of loss involved. However, according to Aristotle, the art of acquiring wealth, called chrematistics, ceased to be natural and became something to be criticized if it was practiced with interest, which means selling time. Indeed, he says that in politics, interest is the most hated form of profit, because the purpose of money is exchange, not production. Money does not create. Aristotle is not alone in this criticism. Beliefs that emerged in the ancient world also brought with them a rigid hostility towards interest. For example, in the Torah, interest is forbidden among fellow believers. In the book of Deuteronomy, Yahweh addresses his servants as follows: "You shall not lend to your brother at interest, whether it be interest on money or interest on grain or interest on anything lent. You may lend to a stranger at interest, but that the Lord your God may bless you in whatever you put your hand on in the land you are going to acquire." Because of these commandments, the Jews avoided this interest, which they called ribbit or nesek among themselves. However, the need for capital continues. To solve this problem, an interesting solution has been found in the halakhic texts, that is, in the Talmudic texts within Jewish law. This is a contract called heder iska. In short, it works like this: I am not lending you money. I am giving you my money as an ISKA or ISKA commercial trust partnership. You, as the manager or agent, manage this money. I am considered your angel investor. If you make a profit at the end of this operation, you give me a share of the profit. If any loss occurs, it is attributed to me because I am the investor. On the other hand, Christianity has adopted this stance against interest. However, Christianity is a religion that criticizes lending money at interest not only among brothers and sisters, but also to anyone. Indeed, usury, called usura in Latin, was condemned even at the First Christian Council, Nicaea, in the following way. It was observed that many people registered in the clergy, having become greedy and driven by the desire for profit, had forgotten the divine commandment not to lend money at interest, and had begun to demand 1% monthly interest when lending money. After this decision, the Holy and Great Synod deemed it just that anyone found to be taking interest, regardless of whether they did so through clandestine transactions or any other fraudulent scheme such as demanding the full principal plus half, should be dismissed from the clergy and their names removed from the lists. According to church law, for example, the Third Lateran Council, usurers were barred from all sacraments, that is, sacred religious rituals. They could not even be buried in Christian cemeteries. However, Christians faced a problem similar to that experienced by Jews. This was because Jews among them could lend them money. Furthermore, since the Jewish community was not land-bound, meaning they weren't engaged in agriculture, they began to engage in low-value, high-value trades. Throughout Europe, Jews were engaged in jewelry making, money lending, and to some extent usury, as well as prestigious professions like medicine. On the other hand, the Christian community was land-bound and engaged in low-income agricultural work. This created a new capital crisis in Europe. In the early Middle Ages, when Christian merchants needed capital, they turned to Jewish moneylenders. This was a very frequent and widespread method. Even European Christian kings, especially when they needed capital, for example, when going on an expedition, preferred to borrow from Jews. For this reason, many European kings encouraged the settlement of Jews in their countries. They even granted Jews certain privileges. However, lending to kings created an imbalance of power. So on one hand, there's a powerful king. On the other hand, there's a moneylender, perhaps even someone without a home. Therefore, when kings borrowed from them, they could somehow find a way to get out of debt. The best example of this is what happened to Aaron of Lincoln, who lived in the 12th century. He lent King Henry £616, or 8 pence for 12 people. Aaron was also indebted to him by almost all the monasteries in England. However, when Aaron died in 1186, King Henry seized all his possessions. He even took over all his debts and receivables. In this way, he obtained such an income that the king had to establish a special unit within the state treasury called the Exchequer of Aaron to track debts and receivables. In popular legend, it is said that the king lost this fortune, which he had acquired somewhat through trickery. Allegedly, he wanted to send this money by ship on an expedition to France, but the ship carrying this treasure sank off the coast of Shoreham. Thus, the king did not achieve what he hoped for. In other words, the treasure he obtained through deception did not benefit him. On the other hand, the debts and receivables continued. As a result, they had written these down in a ledger, and that ledger was in the king's possession. Indeed, in 1190 in York, where these debts continued, Richard de Malbus, one of Aaron's debtors, organized the people against the Jews. In fact, he wanted to get rid of his debts in this way. In those days, Richard the Lionheart had ascended the throne and was preparing for the Crusades. Therefore, he also needed capital. When these two needs combined, a pogrom was organized against the Jews in York in 1190. The city's rabbi, Yom-Tov, and his followers were imprisoned in the fortress until they accepted Christianity. These Jews decided to die rather than become Christians, and under the leadership of Rabbi Yom-Tov, they took their own lives. Afterwards, the surviving Jews of York left the city en masse. This story of the York Jews is actually indicative of a pattern we see widely in Europe during the Middle Ages. Jews are invited to a place to revitalize trade. Capital is created. Then the Jews' high-interest usury begins to disturb people, because everyone ends up borrowing from these Jews without knowing how much they can pay back. Even kings borrow from Jews. Then a pogrom or attack occurs. In this chaos, Jewish property is confiscated, and the story continues. It's as if the books are closed and the accounts are zeroed out. Indeed, there are a number of similar legal regulations in the Middle Ages. For example, the expulsion law in England in 1290 or the confiscation and expulsion decree issued by Philip the Fair in France in 1306 are all products of these dynamics. In fact, Christian capitalists. It's not about borrowing from Jews, because Christian jurists have considered different solutions. We explained that interest is demanded primarily due to capital risk. Christian jurists found different methods to reduce this risk. For example, if repayment is risk-dependent, for instance, if you allocate a budget for a sea voyage and you can only get your money back if the ship returns safely, they would receive a risk fund or risk premium called finis nanoticum. Furthermore, in such contracts, the delayed damage was not considered default interest, but rather compensation for a loss. Going even further, Christian jurists, from the 15th century onwards, even permitted loans with low interest rates under the name Montes Pietatis or charity money. On the other hand, the issue of interest wasn't just a matter for Christians and Jews. As you know, interest, called riba, is also forbidden in Islam. In this respect, Islamic jurists also produce similar solutions to Christian jurists. For example, in Islamic law, the sale of something that does not yet exist is invalid. That is, things that do not yet exist cannot be put up for sale. However, legal scholars permit forward contracts, selim, and contracts of exception, istisna. A forward contract is as follows. Let's say there are certain fruit trees that have just been planted in a field. You can invest capital for the time when these trees will bear fruit and the fruit will be harvested. In this way, the farmer gains access to capital and can obtain a loan by using something that does not yet exist as collateral. A contract of exception is similar. Let's say, hypothetically, you want to have saddlebags made. You give capital to 100 saddlebag makers. When they finish their work, they bring it to you and deliver it. Apart from these, there were much more interesting methods used to solve the capital problem, especially in the Ottoman era. The most prominent of these is monetary endowments. In reality, money is not a product that can be endowed. It's not a piece of land or anything like that. Especially during the reign of Suleiman, the magnificent monetary endowments were permitted. In this way, let's say you are a benefactor. You endow a principal amount of capital. This foundation gives your capital to someone else, and that person manages it according to Islamic principles. They take the income they earn from it and give it back to the foundation. The foundation then uses the income it earns to build madrasas, emarets, schools, roads, and bridges. In this way, merchants find capital, and the profit they acquire is returned to service. Of course, these methods are not the only ways to distribute risk. Ultimately, there are very great risks, especially in overseas trade, and these cannot be solved with such simple methods. In the conditions of the Middle Ages, sea voyages were very risky, and a large portion of the ships that went on voyages did not return. In the ships that returned, there were serious shortages in the crew and the cargo, that is, in the goods transported. To overcome these problems, a solution was found in the Mediterranean world between shares and joint stock companies, which we see in modern markets today. That is the Qurrat contract. This is also called mudaraba. In these contracts in the Mediterranean world, there is a rabul mal, meaning the owner of the capital. Rabul malda gives the capital to a mudarib, someone knowledgeable in trade, and all preparations for the voyage are made by the mudarib. The mudarib sets sail. If he suffers a loss, this loss is attributed to the capital, because the mudarib's only contribution is to transport the ship to its destination with his own labor. If a profit is made, it is shared between the parties at certain and generally high rates. This method is somewhat similar to the hederiska method of the Jews. However, it is the most common type of trade between the Indian Ocean and the Mediterranean, both before and after Islam. First of all, you solve the problem of capital. You distribute the capital risk. The fact that the profit is determined in advance and his high also whets the appetite of the investors to be subject to these contracts. One of the most vivid archives regarding this trade is the commercial documents found in the Ben Ezra Synagogue in Genda, Cairo. Shlomo Gotin published these documents in detail in a work titled Letters of Medieval Jewish Traders. And thanks to these texts, we can see in detail how overseas trade was conducted in the Middle Ages. To simplify, trade worked like this in those years. Let's say we have two investors in Fustat, which is today's Cairo. They want to become partners in a spice trade route to India with 200 dinars. The mudarib, the merchant who equips the ship, divides the cargo into two to minimize losses. He sends one to Malabar and the other to the port of Gujarat. In these ports, the goods are purchased from local merchants through certain negotiations. Let's say, hypothetically, ginger, black pepper, and saffron are loaded onto the ships. The price at which each was purchased is recorded in the ledger. That is, we bought saffron for this price in Malabar and ginger for this price in Gujarat, and so on. Let's also say there was a warehouse expense during the journey. There was a small loss. Several people died. Or a malfunction occurred on the ship. Repairs were carried out. If such expenses were incurred, they were also recorded. Finally, ships laden with spices arrive at the port of Aden. When they unload the goods at an inn, a broker or money changer meets the ship there. Our merchants unload the goods into the warehouse. However, they are not paid immediately. Instead, the exchange rate is calculated, and a document is prepared by the money changer waiting at the port of Aden, showing how much the merchant should be paid. This document is roughly something like this: "Greetings to my partner in Fustat. So-and-so will come to you. Pay him this much money." This was a type of remittance document called sack or suftace at that time. In this way, the merchant would show the document when he arrived in Fustat. Thus, he wouldn't have to carry a large amount of money with him during the journey. These money changers act like agents. That is, there are interconnected money changers along the silk, spice, and musk routes, and they are in contact with each other. Therefore, a highly secure trade is conducted in this way. If you notice, our investors diversified the risk. They set out in two separate ships. Multiple investors were involved, and their risk was limited to the money they themselves contributed. They said, if there's a loss, my capital will decrease. If I make a profit, I'll take the money. Our mudarib, our merchant, perfectly executed the spice trade he had planned. He was also able to equip his ship as he wished. Furthermore, if you pay attention, records were kept constantly throughout the journey. How much did we pay for the goods in Gujarat and Malabar? How much did we lose? How much did we spend? We wrote all of this down in detail in ledgers. As if that wasn't enough, we arrived in Aden. In Aden, the money changers didn't give us our money directly. They said, "Go to Fustat. I have a partner there. Get the money from him. Don't lose the money on the way. Don't let pirates get their hands on it." Thus, we created an extremely secure trade system. Avner Griff describes this system not as a company in the strict sense, but as a coalition, which he explains as follows. Agency relationships allowed Moorish merchants to better distribute risk through diversification, benefit from the expertise of agents, and reduce trade costs by shifting trade activities between trade centers, goods, and times. It is impossible to quantitatively assess the efficiency gains resulting from operating through agents. The superiority of pre-modern trading systems over non-cooperative systems is acknowledged by many scholars. As you will see here, a market of trust was at work. If it was discovered that you had exaggerated the costs of shipping, it would immediately be revealed in this record-keeping system that you were engaging in fraudulent activity, and your reputation would be damaged. Returning to our example, merchants in Malabar would receive a letter saying, "If such and such a sailor arrives, do not give him your goods. He is not trustworthy." You would no longer be able to survive in this market. It was thanks to this climate of trust that a very significant volume of trade was generated on the spice, silk, and musk routes during the Middle Ages. In this way, the Mediterranean world, and especially the Muslim states, amassed considerable wealth and left their mark on the trade of that era. This rising trade was not solely fueled by this trust. A new numeral and calculation system, called the Arabic-Indian numeral, was also being used between India and the Mediterranean world. This is the same system we use today in our modern world. However, this system had not yet become widespread in Europe. Until the mid-1200s, Europeans were forced to work with Roman numerals, which frequently led to inaccuracies. Even the simplest calculations took pages. Expressing numbers in the hundreds of thousands and tens of thousands was particularly difficult. Therefore, a mathematician known as Leonardo of Pisa, anticipating the increasing volume of trade, wrote a treatise called Liber Abaci. This book aimed to teach European merchants in the Mediterranean the practical power of working with 10 digits, including 0. The book contained information on how to perform basic operations such as multiplication, addition, and division, how to calculate currency conversions, and how to determine interest and discounts. The revolutionary aspect of this book was its introduction of these Arabic and Indian numerals into Europe. The author, Leonardo of Pisa, was popularly known as Fibonacci, the son of Bonacco. Indeed, this mathematician, famous for the Fibonacci number representing the golden ratio, was primarily involved in teaching abacus techniques to merchants. In fact, the Italians called this the arte abaco, or the art of the abacus. Children from merchant families, in particular, attended private schools and received specialized training to learn this art. The impact of the abacus facilitated trade, and many people were able to make money from money. This sparked his interest in methods of earning. Indeed, from the 13th century onwards, we see merchants in Europe who conducted business with collateral and pledges. The French ones were called cahorsins, and the Italian ones were called lombards. They would take goods as collateral from people or in exchange for a loan. In other words, they started lending money with contracts that said, "I give you money, and if you don't pay on time, you will pay this much default penalty." Even today, cash loans secured by pledging a security such as a stock or bond are called Lombard loans. Lombard is actually a derogatory term used for Italians. It is used in reference to the old Lombard kingdom. On the other hand, Italians were indeed in first place in trade in Europe at the end of the Middle Ages. Venetian and Genoese merchants had trading colonies all over the Mediterranean. For example, there was a Genoese colony in Galata at the end of the Middle Ages. The building we know today as the Barricade Inn of Abundance was actually the Palazzo del Comune, the residence of the Podesta, the representative of the Republic of Genoa. Venice was similarly a merchant republic. Although ruled by a head of state called the Doge, Venice had a council of 480 members from the patriarchate families, and they were also governed by a special senate called the Council. Therefore, Italians were so involved in trade that they established merchant republics. The new class of moneylenders, called Lombards, rose to prominence in Europe thanks to the art of the abacus. Lombards would sit at a counter while conducting their commercial transactions. The Italian equivalent of this is bank or banco. This word should sound familiar. Yes, the term bank was first used for this Lombard trade. In fact, an urban legend says that the word bankrat, meaning bankruptcy, comes from bancarata, meaning broken counter. According to the legend, in case of bankruptcy, these counters were ritually broken, and this was how the Lombards' bankruptcy was announced. Half a century after the writing of the Liber, we encounter the first supercorporations, or what we might call banks, in Florence. These institutions were actually family businesses. Families like the Bardi and Peruzzi were the first to operate in this sector, and we can also call them the first bankers in history. These bankers established a trading network extending from Florence to Bruges, Avignon, and even London. They both collected papal revenues and directed the raw materials trade. Similarly, large-scale loans generally came from their hands. Indeed, the first global corporate crises were experienced by these Bardi and Peruzzi families. In 1346, the Bardi family could not collect a loan they had given to King Edward of England. Edward defaulted on the debt. As a result, the Bardi firm ended and went bankrupt. Due to a similar risk distribution crisis, the Peruzzi family also went bankrupt in the same year. This time, the Medici family, a small partner of the Bardi family, began to come to the forefront. This bank, initially managed by Giovanni Bisi de' Medici and later by his son Cosimo de' Medici, differed from others in its meticulous working methods. Each branch of the Medibank was a separate partnership. Each branch had its own profit pool and performance accounting. Furthermore, they began preferring smaller merchants over risky clients like kings. Ultimately, the Medis entered a field of trade that neither Jewish moneylenders, nor Lombards, nor Bardi and Peruzzi could perceive. Among them was a communication network called Avviso di Pagamento, which could be described as bank recommendation notes. Thanks to these notes and bulletins, everyone performed risk analysis, and credits to customers were limited accordingly. This is actually very similar to today's risk analysis and credit rating. More importantly, the Medis had invented a debellentry accounting system. That is, they didn't simply write down receivables and payables. Receivables and payables were listed in two columns, following each other. Thus, the current state of the firm could be clearly and continuously accounted for. This trade volume and intelligence would soon propel them to the leadership of Florence. However, let's leave this colorful story of the Medicis for another video. Let's continue with our topic. One characteristic of Italy in those days was that it was divided into city-states. These states were constantly at war with each other. Furthermore, city-states like Venice were eager to go to war to find colonies abroad and facilitate their trade. As the ancient Greek philosopher Heraclitus said, war is the father of all things. Therefore, these war-hungry city-states became the creators of new institutions, government bonds and public borrowing. For war, city-states generally paid subcontractors called condottieri. These were mercenaries. Some of them weren't even Italian. For example, Sir John of England. These were foreign names. Although they generally operated on the principle of wage war, share the spoils, occasional payments were necessary. This created a desire for debt in states. In fact, classical states levied taxes on their citizens. They collected one-time taxes, mostly in kind, and they financed wars in this way. However, Venice and Genoa were republics, and republican citizens were not very eager to lend money. Therefore, in 1260, the Republic of Venice decided to borrow from its citizens under the names of Prestiti and Monti. These loans were to be taken and repaid with Venice's future tax revenues. The Republic offered its own taxes as collateral. The same method was tried again during the wars between Florence and Pisa in the 1360s. However, this time, the state began to promise a certain amount of interest in return for the forced borrowing called prestanza. You fund my war, but I won't pay you the principal immediately. I will pay you a certain amount of interest. I will give you the principal amount later, along with the spoils I obtain from the war. Therefore, you won't suffer any losses in the meantime. It's actually a very clever system. The war is treated almost like a startup, and citizens become angel investors in this new venture. Today, government bonds work more or less on the same principle. You receive guaranteed monthly or annual payments. Thanks to this method, the state easily provides a source of debt with its own resources. You also make small profits. This method actually greatly increases the size and economic power of states, because they can find as much debt as they want this way. In fact, this is called Monte Commune, or mountains of public debt. Today, the most indebted countries are actually the richest countries. As you know, the more debt you can find from the market, the richer you are. Indeed, Neil Ferguson explains the situation as follows. An important element of the system in Florence was that if the investor needed ready cash, these types of debts could be sold to other citizens. In other words, although bonds at that time were just a few lines written in leather-bound ledgers, they were a liquid asset. Florence transformed its citizens into its largest investors. By the beginning of the 14th century, two-thirds of households were contributing to the financing of public debt. But the vast majority of payments came from a few wealthy individuals. This oligarchic power structure gave the bond market a solid political foundation. Unlike in an unreliable kingdom where power was hereditary and arbitrary, in Florence, those who issued bonds and those who bought them in large quantities were the same people. It is therefore not surprising that timely interest payments were in the best interests of these individuals. As you will see, the method of buying and selling a security, which we now see in modern stock exchanges, was actually developed in Florence and similar city-states. Because this method was so clever, it spread rapidly throughout Europe. Every state began issuing its own bonds. Even without war, they began borrowing from the public for various expenditures. They achieved substantial budgets by paying only small interest payments without paying the principal for a long period. This created a solid source of income for the rapid growth of European states. Bonds thus emerged at the end of the Middle Ages and the beginning of the Renaissance. However, we have one missing piece on the road to modern stock exchanges: shares. Of course, for shares to exist, publicly traded companies must first be established. Naturally, in the Mediterranean, as I mentioned earlier, there were partnerships based on mudaraba and musharaka relationships, particularly prevalent in the Islamic world. However, in these, you knew the partners, and the shares were not transferable as anonymous shares. That is, I couldn't sell the capital I had invested for the spice trade from Malabar to someone else. The first companies where shares could be transferred appeared in Italy. For example, the Genoese had a type of partnership they called Mauna. Investors collected capital and equipped ships. These ships sailed and conquered certain regions. The profits from the mines, taxes, and other sources were distributed to the partners almost like dividend payments. The most famous of these was the Mauna di Chio de Foggia, or the Chios and Fossa Mauna, run by the Justinian family. This company had taken over Fossa, our Izmir, and Chios Island. From 1346 to 1566, it imported mastic from Chios Island and alum from Fossa to Italy. In this company, you could sell your creditor shares, called logi, in advance. That is, before payments were made, you could transfer the share to someone else, saying, "Look, brother, such a payment will come in the future." A similar company was established in Cyprus, again by the Genoese. Then, in 1407, a company called Casa di San Giorgio, or the House of St. George, was established. Another company was established. This company engaged in activities such as buying and selling Genoese government bonds and lending to those seeking credit. However, it grew so large that it also became involved in customs and tax collection, even acquiring judicial and military functions. Indeed, Machiavelli called this company a state within a state. The foundations of large companies that surpassed the state, such as the East India Company, were actually laid by the Genoese during this period. On the other hand, it was the geographical discoveries that truly created the stock market. In fact, Christopher Columbus even signed a contract similar to a mudaraba with the Spanish crown. According to this, 10% of the profits would go to Columbus and the rest to the crown. It was something like a contract between the Lord of Finance and the mudaraba. Of course, let's mention in parentheses that Columbus never fully collected this amount, and it became the subject of a lawsuit for decades. We touched upon this point in our Andalusian documentaries. On the other hand, the new merchant class in England and the Netherlands, participating in the colonial race, developed a more creative solution than Columbus. Initially, they equipped ships piecemeal using traditional methods and sent them to India. However, trade with India was much riskier than others. For example, in 1598, only 12 out of 20 Dutch ships that set sail returned. The risk was great, but the profit was also great. For instance, a ship full of black pepper could bring in enough profit to equip 3 ships. However, these profits were one-offs. At the end of the voyage, everyone took their share and stepped aside, and the partnership dissolved. The merchants began to organize themselves to make this trade sustainable. First, King George of Cumberland and 218 English merchants applied to the Queen for a trade privilege. On December 31, 1600, an organization called the London Governor and Merchants Company, which traded to the East Indies, managed to obtain a trade monopoly. This 15-year concession would be renewed, and the company would transform into the East India Company. The partners in this company were clearly defined and consistently received a share of the total trade. In the Netherlands, during the same period, the General Assembly governing the country merged 6 separate Dutch subsidiaries to form the company whose name I will now read, a rather long one, Verenigd Nederland Geo-Trou Oosten Company, the United East India Company under Dutch protection. Its Flemish abbreviation is VO Clind. This Vogue company was managed by 17 lords, known as Heeren 17. However, the number of shareholders was much larger, and there was no limit to the investment. These lords acted like a board of directors. In fact, it entered the trade with a considerable amount of capital. However, due to armed conflicts with the Spanish, this trade was soon jeopardized. In the year 1612, the year of the balance sheet, it was announced that the principal could not be paid to the shareholders. In other words, dividend payments would continue, but no one could withdraw their principal. Shareholders who wanted their money back were left with only one option: to sell their shares to other investors. This way, those who needed their principal would receive their shares back. Investors who weren't in a hurry would enjoy the dividend payments. Thus, these types of securities began to be bought and sold, and these companies transformed into joint stock companies. A new type of company emerged where the identity of the shareholder was irrelevant, and only capital and people were involved. In fact, the sale of these types of securities, especially government bonds, was already an established practice by the 1500s. The first stock exchange was the Wiener Boermarkt in Bruges, opened for the sale of MTA, minimum written tax. Active until the 16th century, this market was named after its founder, Robert Wiener Boers. This family surname also came from the Latin word bursa, meaning money purse. Over time, markets dedicated to specific products came to be generally called bourse or bourse. In 1531, another bourse was opened in Antwerp for the sale of English government bonds. Here, both MTIA commodities and government bonds were sold. In 1608, a new marketplace for Vogue shares was established in Amsterdam. In Dutch terms, the stock exchange opened. Thus, the first modern stock exchange was born. Let's refer to Ferguson again for what happened next. The courtyard of the first stock exchange in history, with its columns and clock tower, resembled a medieval Oxford college. What happened between 12 noon and 2 p.m. every business day was revolutionary. One witness of the time described what happened in the trading room towards the end of a typical session. Handshakes were followed by shouts, insults, insolence, and pushing and shoving. Buyers or bulls fought with sellers or bears. The excited speculator would bite his nails, crack his knuckles, close his eyes, pace back and forth 4 times talking to himself, and put his hand on his chin as if he had a toothache. While doing all this, he would mysteriously continue to cough. We also have a similar experience with the Grand Bazaar. The scenes we are accustomed to seeing, familiar from the informal stock market, unfolded in Amsterdam in those days. In fact, stock market sales and the profits derived from them began to whet everyone's appetite. Over time, bargaining and transactions became much more speculative. This was followed by other new stocks. Indeed, the first market bubble in history would emerge in this way. This bubble is called the Mississippi Bubble, or the Mississippi Stock Crisis. The main character of the crisis was a Scotsman named Jean Lowe. As we have previously explained, in Scotland, special banknotes or banknotes, which made debt obligations transferable, were converted into paper money by the state. In 1695, the first state-backed paper money was printed in Scotland, and it continues to be printed today. The Bank of Scotland is the state bank that has continuously printed banknotes for the longest period in the world. It was in this environment that John Lowe, a financier, began to imagine a new economic model. According to this model, the state should abandon coins and switch to paper money. A state-owned company should be established, and joint stock shares should be issued. Thus, the state's debts to the public would be paid not through bonds, but through these shares. This would allow creditors to profit. Furthermore, banknotes would allow for a steady supply of money to the market, even if there wasn't enough metal for coinage. Citizens would then use this money to buy new shares. In theory, it seems like a perfect idea, and when you imagine it, it's an economic system that would actually work remarkably well. To realize his ideas, Jean Love first established a private bank in France called Banque Generale. At that time, France was in an economic crisis, heavily indebted, and unlike other states, it had no colonies. Therefore, this enterprise established by John Love attracted considerable attention. The Duke of Orleans, who was acting as regent in the absence of the king, was one of those interested. John Love, being a somewhat eloquent man, managed to convince the Duke of Orleans to participate in the project, and in 1718, he transformed his own bank into a state bank called Banque Royale. In other words, the state essentially bought Jean Love's bank. This bank begins printing banknotes on behalf of the government and introduces them into the market as convertible instruments of payment. At that time, to pay off government debts, a company called the Western Company or the Native Company, as envisioned by John Love, is formed. It is established, and the monopoly of colonial trade is given entirely to this company. Jean Love even names the new colonial area opened by the company New Orleans as a gesture to the Duke of Orleans. When citizens heard about this new state-backed project, they began lining up to buy shares. Love cleverly planned these shares in two separate levels, one for mother and one for daughter, and the sale of shares began. In reality, these shares, known to the public as Mississippi shares, were not based on real trade. That is, they were not based on ships that were actually operating and constantly moving, like the East India Company. They were largely based on the buying and selling of papers. Indeed, Mississippi can be considered like the projects that virtual currencies advance today. The real value of the project is irrelevant. What matters are the papers produced through that project. Therefore, the English writer Daniel Defoe reacted to the situation by saying, "The French have started buying and selling air." Furthermore, the French writer Voltaire, in a letter he wrote, asks, "Has everyone in Paris gone mad?" The French have completely lost themselves in this, and this expectation is gradually turning the market into a bubble. Shares that started at 500 livres are rising to 12,500 livres. Meanwhile, John Love continues to issue new shares. Because ultimately, he starts creating a ton of shares out of thin air, thinking he will pay off the state's debts with them. On the other hand, he has risen to the level of finance minister and is making legal arrangements for the public to switch entirely to paper money. He has also printed banknotes 4 times the amount of gold and silver reserves. There is something that even our finance minister couldn't calculate. That is the fact that when there is an excess of something in the market, its value also decreases. Therefore, the real value of banknotes in the market begins to fall rapidly. Even though people don't realize it, inflation begins to rise rapidly. The purchasing power of money gradually decreases. Some sensible investors, and especially the French, have tried to return to gold and silver. This trend, however, John Love legally prevented them from doing so, enacting a regulation that prohibited people from carrying more than 500 livres in gold. As if that weren't enough, when the workers who were to work on the Mississippi Project arrived in Louisiana, they were met with hellish heat and swamps teeming with insects. Within a year, 80% of these immigrants died from starvation or tropical diseases like yellow fever. As you can see, the Mississippi Project essentially ended before it even began. Due to this insecurity and the bad news that followed, the French began selling their shares little by little, and the value of the shares fell. These depreciated shares then fell into the hands of the state. By the beginning of the 1720s, 2/3 of the shares remained in the state's possession. Banknotes were initially designed and legally regulated as fixed-value currencies. However, as I have stated, their real value decreased day by day. Finally, in May 1727, the state was forced to declare devaluation, lowering the value of the currency. Immediately following this, the shares also fell from 9,000 livres to 4,000 livres within 15 days. It's falling. This combined fall causes many French people to go bankrupt. Angry crowds begin protesting in front of banks. They reach a point where they demand John Love's head. The more Love tries to save the country, the deeper it sinks, and finally, in October, France returns to the gold and silver standard. Also, by December, shares have fallen to 1,000 livres and below. Finally, Love writes an apology letter and flees the country. Thus, the Mississippi bubble bursts. Because of this bubble bursting, many people in Europe went bankrupt at that time and a great wave of anger arose. For example, a Dutch investor expressed his anger with satirical plates he had made in China. One of these plates reads, "Oh my God, all my shares are worthless." Another reads, "Shitty shares and wind trading." There are also many engravings from the same period that make fun of this situation. In an engraving called "The Official Name of This Folly," a figure is depicted eating gold and defecating Mississippi shares, while brokers walk around with their buttocks exposed, which is John Love's. In yet another depiction, we see John Lovell as a vagabond making empty promises, riding in a carriage pulled by two unkempt Gallic roosters. The work that best reflects the scale of the disaster is Bernard Picard's engraving titled "Monument Dedicated to Future Generations." Here, you see impoverished Dutch investors being led to an asylum. Also included in the same image is a scene of the naked Fortuna, the goddess of fortune, showering Mississippi stocks. This bubble was the first stock market speculation in history. As the saying goes, once bitten, twice shy. This collapse kept France averse to banknotes and stocks for a long time. France adopted a conservative and cautious economic stance, and in fact, lagged behind in all economic developments during that period. This also affected France. It prepares the ground for an economic crisis that fuels a sudden revolution. Thus, France's late capitalist development and its inability to adapt to this stock market system also brings about the end of the French kingdom. On the other hand, these bubbles did not end in those days. Other inflations, such as the South Sea bubble, occurred in the market, but people never lost interest in these kinds of stocks, because that was the spirit of the times. Just as it is today, as Alexander Pope said in The Age of Hope and The Golden Mountains, not investing was seen as a shameful act in the spirit of that era. Yes, sir. So we have largely tried to reveal the origins of modern finance. I have tried to present the basic points of the matter to you as much as someone who doesn't understand much about investing can explain. The journey, which began with the problem of finding capital, ended with imaginary stocks and shares that traded in hope to people. However, of course, the history of finance did not end there, and this financial world has continued to live on, diversifying to this day. I hope I have been helpful. To ensure more content like this, don't forget to subscribe to our channel, like and share our videos, and hype us if possible. See you in the next video. Stay right, stay lawful, stay wealthy, stay healthy.